Okay, time for a little more perspective. Like in March, my grandmother turned 102. So how's that for the fact that we might be living a little longer than we think we're going to be, and we might need to be planning for that. This is Tyson Ray, financial advisor at Forum Wealth Advisors, where we exist to help make life better for our clients and those in our community. And this is up or down for March. And as March comes to a close, the market's finished up as it digested, again, just a lot of good information that's out there. And in this up or down, I want to talk a little bit about interest rates because I think there's a lot of misunderstandings out there as to what's driving the markets. But my greatest fear isn't these markets. My greatest fear is the bond markets. My greatest fear is those savers that like to put their money in investments that they think are safe and they can take interest and income and retire off of it. Those bond investors that have benefited for the last several decades of a return in bonds, which was a capital gain that historically speaking actually doesn't show up in bonds. In fact, as the rates have come down to zero in the light of the COVID stimulus, we have nowhere to go but up. And up we went a little bit in March, which caused some volatility in both the bond market and the stock market. But I want to take you back to some studies that I was in a few years ago that show long-term historical trends in both interest rates and in bond returns. So first, let's do a little recap on interest rates in general. All the interest rates that we remember have been going down. And when interest rates go down, the value of bonds goes up. And so bonds have been a really good investment in a lot of different ways over the last several decades. But if interest rates goes down and the value of bonds goes up, what happens when interest rates rise? Well, actually, one probably doesn't remember because it's been so long since we've been in a long-term rising interest rate environment. And that's what I think we're heading into, to digest all this stimulus and all this economic activity that's going to take place over the next few years. We are likely to see some inflation and we're likely to see the Fed start raising interest rates. And that can have an interesting effect on one's bond portfolio. I will take you back into the 1950s, when was the last time you actually had an environment maybe similar to ours. And our government is doing a lot of things that it did back in the 1950s, lowered interest rates, put a bunch of stimulus into the economy, had millions of people that were coming back from the war that needed to be put to work. And what happened? It worked, and the economies in the 1950s and 1960s did really, really well. Interest rates in the 1950s rose almost for the next 30 years, peaking in the 1980 timeframe, and then dropped for the next several decades. And whether interest rates stay at these lower levels or go higher, I don't think they're going to go lower for longer. And in fact, back when the study was done ending in 2016, they were concerned where interest rates were at that time. And if you notice on that chart, they continue to go down literally to zero before they now have come back up. So what you can see in the bond market in the 1950s was for that whole decade dealing with a rising interest rate environment that was also dealing with a booming economy that followed behind it. It had a zero rate of return, basically, net after inflation in almost every area of the bond market. The mistake I don't want you to make is I don't want you to think that your bonds are safe. Your bonds are an investment that have different types of risk, and actually because those risks have been rewarding you, especially for the last few years, you think you want to keep them because they don't have some of the volatility. And what you're going to find out over the next decade, likely, that we found out in the 1950s, is what brought you comfort may actually lose you money in exchange for an investment that continues to go up in the marketplace that you're not in. And so for many people, they need to relook at their asset allocation and try and understand what are your long-term goals and how do those goals need to be managed into these current environments. Because if you think that after COVID, after a new elected president and administration for the next 4 years, after record stimulus, if you don't think something should change in your portfolio allocation and that everything can stay the same, you might regret that decision. And our job is to try and help clients make educated decisions now, so when we look back on those decisions in the future, we don't regret the decisions we make. And that's a kind of a conversation we are trying to have with our clients. And if you would like to have that conversation, give us a call. Until we see you again next month, this is Tyson Ray, financial advisor at Forum Wealth Advisors, where we exist to help make life better for our clients and those in our community.